All right, so let's do our our second problem here, second example. And after this, you guys are done listening to me lecture. This should be the last lecture video. I would imagine you're pretty excited about this. So bear with me for another 10 or 15 minutes here, and we will rock through this problem. And if you guys got any questions, comments, concerns, just get a hold of me. I will walk you through whatever we need to walk through. So let's take a look at this here. And this one's going to get a little confusing, but we're going to stop and we're going to explain some things as we walk through this, okay? So here we've got a trial balance, right? This is our trial balance for the Ombudsman Foundation. It's a not-for-profit organization. They provide training and dispute resolution, conflict management, all right here in the facts. So here's our pre-closed trial balance, right? So what does a trial balance tell us? Well, what a trial balance tells us is our debits and our credits equal. It does not tell us that we have any errors contained within any of our account balances, right? Then we get our adjusted trial balance. Adjusted trial balance then makes sure that A, debits and credits equal. B, now we have the correct amounts in our accounts, right? We've made all of our adjusting entries. Okay, what we have here is our pre-closed trial balance. So this is kind of like our adjusted trial balance, right? This is what we're going to use to actually close the books at the end of the month. Okay, so this tells us we've got the correct balances in our accounts, right? So just a quick review, Accounting 201, Intro to Financial Accounting. Like I've told you guys before, it does not hurt to go back and review the fundamentals, because I would imagine it's probably been a while since most of you have actually looked at trial balances, right? So one thing I would like you to do, and we've done this all throughout the entire course, pause this video, okay? Go through and label them. Are these temporary or permanent, right? Is this a temporary account? Is this a permanent account? What does that mean? Well, temporary accounts, we're going to close. Permanent accounts remain open. They've got a rolling balance. They roll to the next period, right? So just recall, anything that's a revenue, anything that's an expense is going to be temporary. It's going to get closed. Anything that's an asset, anything that's a liability, those are permanent. Those have rolling balances, right? They're going to stay open. Those are permanent accounts. We don't close those. So label these temporary or permanent. Also go through and try to label these as unrestricted, temporarily restricted, or permanently restricted. Okay. So all of this is going to help you when we go to create any journal entries that we might need to create, when we go to create our financial statements, right? So with this being a pre-close, I would imagine, hopefully you guys realize we're going to have to make some closing journal entries. So that's where we're actually going to start. We're not going to start with any adjusting or any original journal entries. We're going to start with closing journal entries. So go through, label these temporary or permanent, and then also label them unrestricted, temporarily restricted, or permanently restricted. Okay, and just remember, these are going to be closing entries. That'll become important when we talk about some of the reclassification journal entries. So pause the video now, take a minute, fill that out. All right, so since I know everybody paused this. I mean, you couldn't wait to pause this and go through and fill out whether or not these were temporary or permanent, right? So here are the answers. Hopefully you got pretty close to these, right? If you didn't, let me know. We'll walk through it. Why is this an unrestricted? Why is this temporarily restricted? Why is this permanently restricted? Anything like that. So you'll notice here we've got some marked in red, okay? So we've got lands and building, our PP&E, right? Land, property, buildings, plant, equipment. And then our accumulated depreciation. That's how we're going to calculate our capital or net capital, okay? Pretty simple. I mean, it really, you guys know assets, contra asset accounts, how those work. So, all right, so here are a few more for you to go through. Again, pause the video, go through this and try to label these as temporary or permanent, and then unrestricted or temporarily or permanently restricted. All right, so welcome back. Hopefully you guys have done that. Here is how all of this lines up. Okay, and what you'll notice here, when we get down to the reclassifications, we're going to talk about those first, because this is kind of a weird situation, right? Remember, I told you we're not going to start with the adjusting entries or the original entries. Those have already happened. What we're going to start with is the closing entries. So we're going to have a little bit here. Sorry, this keeps getting a little messed up. What we're going to have here is something that seems a little backwards while we're doing it, right? So we know that, let's just start with our basics, right? We know that our temporarily restricted and unrestricted net asset accounts are kind of like our equity accounts. So when we want to increase them, we're going to credit them. When we want to decrease them, we're going to debit them. So what's happened is, for instance, when we had an expense that was restricted for a purpose, like the teacher salaries in the last example, right? We debited the temporarily restricted account, purpose restriction, and we credited the unrestricted account, and that moved that from the temporarily restricted account to the unrestricted account. So what we've got now, if we look at this T-table on the left, this is going to be our temporarily restricted accounts, and then the one on the right is going to be our unrestricted assets. So when we reclassified, we debited it to decrease it, which, when it leaves us with an ending balance, leaves us with a debit balance, right? Which is incorrect for this. We want to, typically these have a credit balance. It leaves it with a debit balance. So how do we close that out? Well, we got to credit it, right? So when we're closing that reclassification, we have to credit it, okay? So when we had an increase in unrestricted assets, we got a credit, right? We were increasing it, okay? That was during the reclassification process. So that left us with a credit balance. So in order to close that unrestricted net asset account, we need to debit it, right? And that's going to be closing entry number 1. So you see we've got 2 different closing entries here, but what you'll see is these are going to net each other out, right? So let's go ahead and work through that so we can kind of see that process. So here we're going to prepare the closing entries for year end, okay? So like we've done all semester throughout the entire class so far, we're going to start with our inflows. We're going to close any inflows of resources that we have. So that's going to be the reclassification to unrestricted net assets. That's one of the journal entries we had. That's going to be a debit, right? Because we ended after the reclassification with a credit amount. And then this is the other one. The other reclassification that we made. So again, notice here it's a debit. We're debiting to close these, okay? So don't let that freak you out too much. Just realize that we're starting at the closing entries. We're not starting at the adjusting or reclassification entries. The reclassification's already happened. So if you follow those T accounts, if you write down T accounts and just see what you get, right, you'll see that you need to close these accounts using a debit balance for the unrestricted net assets, okay? So let's keep on going. We've got contributions unrestricted. We got program services unrestricted. And then we had net gains on the endowment investment that was unrestricted, and contributed services unrestricted. Okay. So the next thing we always know step 2 is going to be to close our outflows. So let's close outflows of cash. Outflows of resources, sorry, not just cash, but outflows of resources. So we had training seminar expense, education program expense, research program expense, management and general expenses, and then we had fundraising expense. So notice those are all debit or credits. Why? Well, increase in expense with a debit, decrease in an expense with a credit. When do you decrease expenses? Well, when you're closing the account, right? So since expenses are a temporary account and increase with a debit, we're going to close and decrease those with a credit. Again, just intro to financial accounting review. It never hurts to brush up on your fundamentals, right? So we're going to close everything to net assets. We know that our debits have to equal our credits, so we add up our debits, we add up our credits. What is the variance? The variance gets closed to net assets. So we have net assets unrestricted, $695,100. So remember, we are closing the unrestricted assets here. Next, we're going to close up the temporarily restricted assets. So again, we're going to have contributions that were temporarily restricted. We're going to debit those. Grant revenue, temporarily restricted. Again, it's a debit. And then here's our reclassification entries. So if we recall, when we reclassified, we had to credit those temporarily restricted net asset accounts, which left them with a credit balance. So we had to debit those. I apologize. Let me restate that. When we reclassified from temporary to unrestricted, okay, we had to debit the temporarily restricted net assets account to decrease it. So it left it with a debit balance, meaning we needed to close it with a credit balance, which we'll do here. That's that $214,400. And then we have the second reclassification for $261,600. And then again, we are going to close everything out to net assets. So add your debits, add your credits, the variance gets closed to your temporarily restricted net assets account. Okay. So number 3, closing entry to close the permanently restricted net assets account. This is simple because remember, closing or your permanently restricted net assets aren't going to have any transactions. There's not going to be any original or you're going to have an original journal entry, but you're not going to have any adjusting journal entries. You're not going to have any balances, right? So what you're going to have is you're simply closing it out. So contributions permanently restricted. Okay, that's kind of like your revenue, right? So you're going to debit that to close it, and then your net assets permanently restricted, credit it to close it. Okay. So let's go ahead and prepare a statement of activities for the year ended December 31st, 2017. So you'll see here we've got 3 columns: unrestricted, temporarily restricted, permanently restricted, and then you have your 4th grand total column there at the end. So just go through and list everything. Okay, so contribution revenues, we had a little bit of everything. We had unrestricted, we had temporarily restricted, we had permanently restricted, and then you just total everything up. We had a little bit of contributed services, we had some grant revenues that were temporarily restricted, and then we had some gains on that permanent endowment. Okay, so here we have the net assets released from restriction. These are those reclassification journal entries, right? So you can see here, they're going to net to 0. This is what I was telling you guys earlier. At the end of the day, these are just going to net to 0, right? They have no real impact on your total net assets. You're simply moving them from one bucket to the other, okay? So here, just total up your revenues for each column, and you'll see we have $12,034,900 in total revenues. So now we'll go through the bottom part of our statement, and this is going to be the expenses. Okay. So training, and remember, see, we've got this big X here for temporarily restricted and permanently restricted accounts. Why is that? Well, we're on to our expense portion, right? And the expenses all have to be unrestricted. So training seminar expense, education program expense, research program, total program service expenses, fundraising, management in general, total supporting service expenses, total expenses, and then an increase in net assets. So your total revenues minus total expenses, right? So you are going to fill out this total line for your temporarily restricted and permanently restricted because you had $438,800 of temporarily restricted revenue, but $0 in temporarily restricted expenses because all of your expenses are unrestricted, right? So there we can see our total increase in net assets. We're going to look at the facts, back at the fact pattern, see what was our beginning balance for each of those. And then we're going to look at our net assets as of December 31st. This is going to be the increase or the change in net assets plus the beginning balance of those net assets. Pretty simple, right? So just a reminder, once again, all expenses are reported in the unrestricted column, okay? And this is what your full statement of activities is going to look like. Let's finally work on a statement of financial position. This is essentially your balance sheet, right? And again, just I've kind of said this several times throughout the class, but the way I kind of remember that is, you know, your balance sheet is your, it shows the financial position of your organization, right, as of a certain day. So when you see statement of financial position, you can think balance sheet. So what are our current assets? We got cash, we've got short-term investments, we've got inventory, we've got some receivables, we've got pledges receivable, we've got accrued interest. Pledges receivable, that's something you're going to want to read through the text about. There are some oddities that occur with pledges. You know, if I say that I'm providing you $100,000 when I die, and that goes in my will, does the organization get to claim that immediately, or do they have to wait till I actually die to claim that money in their revenue? So read through the text, it'll go over things like that. So accrued interest, and then total current assets, non-current assets, pledges receivable, long-term investments, and then P, and E. Total non-current assets, total assets. Now, that's a number. Circle that, write it down, remember it. We're going to need it later. $6,652,400. Let's go through liabilities. We had accounts payable. That was it. So total current liabilities, $24,700. Then we had some post-employment benefits that are payable, $196,600. That's related to like retirement funds, right? So we have total non-current liabilities, $196,600, and total liabilities of $221,300. Now, we are going to pull the net asset balances for the classifications from the statement of activities. So our three classifications, unrestricted, temporarily restricted, permanently restricted, we'll fill those out. That'll tell us our total net assets, $6,431,100. We add our liabilities to that to get total liabilities and net assets, $6,652,400. If we go back and look at our statement of activities, we'll see that those two numbers balance, which is what we expect. This is the totality of your statement of financial position. Just get familiar with it, how it's set up. I mean, this is basically a balance sheet, right? There's not much more from it. Just remember that you need to do your statement of activities first and then your statement of financial position, just like we would typically do in a for-profit income statement, retained earnings, balance sheet, right? Same thing here. We're going to do statement of activities, then statement of financial position, because we need those classifications of net assets, unrestricted, temporarily restricted, permanently restricted, in order to complete this statement of financial position. So before we go, let's answer just a couple. I think there's 5 multiple choice questions to just kind of answer about chapter 10, right? So how should expenses be reported in an NFP statement of activities? Well, I've said this 100 times so far in the videos and the lectures, so we should know at this point that it is a decrease of unrestricted net assets, right? Because all expenses get classified as unrestricted net assets. Number 2, if a donor provides that interest earned on an endowment be used to finance a particular program, how should the interest revenue be classified? Well, it's not unrestricted because they've placed a restriction on that, right? So it's got to be temporarily restricted. It's not permanently restricted. The endowment, the corpus, the principal, is permanently restricted, but the interest isn't. Although they do say the interest has to be used for a specific purpose. So it's got to be temporarily restricted. So at the balance sheet date, the fair value of an investment is greater than the amount at which the investment was initially recorded. What adjustment, if any, is needed? So the thing to know about this question is, just like with governmental accounting, just like what we were doing in the previous chapters, we don't get to differentiate between realized and unrealized and recognized gains and losses, right? Everything is recognized for us, okay? So you're going to record any gain or any loss in the same net asset class in which the investment is reported. So if it's in temporarily restricted, that's where you're going to report that gain or loss. So just remember, just like with government and NFP, you do not get to differentiate between realized, unrealized, and recognized gains and losses. They're all recognized, okay? So number 4, say we got a computer expert. He donated 60 hours of time to the museum. He spent 40 hours designing a website, so 40 hours doing what he's a professional at, and 20 hours selling merchandise at the museum store. So something that literally anybody could go in and do, right? So he normally earns $150 an hour when he designs websites. We've decided that's the FMV for that service. And the museum normally pays $10 to its salespeople. How much should the museum report as contribution revenue for Mr. LaVille's services? Well, pretty simple. Recall, we only record contributed revenue for something that we would have to pay for, typically, right? So that means that those 40 hours that he spent designing a website, we're going to charge $150 towards our contributed revenue and towards an expense, right? So that's going to be $6,000. We don't charge for the time that he spent working in the museum's gift shop, right? We only charge for the 40 hours that he spent designing a web, because we would typically have to pay a professional to design that website. And then finally, number 5, the entry to record the expiration of program restrictions include which of the following? So, do we credit the reclassification to unrestricted net assets? Yeah, we do that because we've got to increase unrestricted net assets, right? Because that time or that purpose has been met, and so now we can move those temporarily restricted net assets to unrestricted. And then so we know A is right. B, do we debit reclassification from temporarily restricted net assets? Yeah, we do, because we've got to decrease that. We're moving it from one bucket to the next. So we know there's 2 parts to that, right? And then C, credit reclassification from temporarily restricted net assets. No, that would increase it. So we know at the end of the day, the answer is D. So any questions? Please feel free to contact me. I'm happy to discuss them with you. And that is it. That is all of the new content we're going to discuss in this class. Everything else is either extra credit or presentation work. So like I said, any comments, questions, concerns, anything like that, just get with me, and we're happy to go over it with you.